Welcome to the Get Real Podcast, your high-octane boost of full-on reality therapy for personal, business, and investing success with your host, Ron Phillips, because somebody's got to tell it like it is.
Hey, everybody. Welcome back to the Get Real Podcast. Ron Phillips and Heather Marchant back for another amazing show.
That's right. Although I'm back a little tanner because we just got back from a team trip to the Bahamas, which has become one of my new favorite places.
It did not suck.
No, so beautiful.
Where are the Bahamas?
We were in Nassau and we were on a cruise. So Royal Caribbean's private island. I don't know. It was a little overrated for me, but I just like the Bahamas itself. Beautiful. The ocean was breathtaking.
Yeah. It's the water.
Yes.
That's amazing. And that other voice you're hearing is our great friend, Jon Galane, who is on the show with us. We're super excited about that. Welcome back to the show. Jon has been on the show a couple times at least. Yeah. And anyway, welcome back, Jon.
Thank you.
Yeah, we couldn't pass up the opportunity to have you talking with all the shenanigans, I'm going to call it, going on with the banks. I thought, man, who better to share some insight than Jon
For
Galane.
those of you who have not listened to the other couple of times that Jon has been on, shame on you. You should go look him up. But I'll introduce Jon. He's not only a great friend of ours. We spoke together on the road for 8 years, something like that. It was a long time we spoke together on the road. And Jon is really, really smart, especially in the financial world. He comes from the quote, real financial world and all of the, we'll call it the dark side today, Jon, but all of the normal traditional investments. And so he understands that side really, really well, but transitioned many years ago to the light side, to the wonderful world of, I guess, hard assets or non-traditional assets like real estate and other so many fun assets that you can deal with. Jon is the owner of Mountain West IRA. They do self-directed IRAs. They're the best in the business. We love working with them. We've sent tons and tons of clients over to them and just really enjoy working with them. Best in the business. We have Jon here for his brain. He's my go-to for anything that goes nuts in the financial industry. I call Jon like, what the hell is going on, Jon?
And that's the question of the day, isn't it?
It is.
Yeah, right? No kidding.
I'm not sure I can shed much light on it, but I'll certainly give my opinion.
Well, I just remember back in the day, too, that you did, what was it, like an 8 or 10 hour continuing education class on self-directed IRAs? I mean,
Those.
You still do?
Yep.
Wow. Phenomenal.
Once a year, though. They're too hard. Getting too old to do them more than once a year.
Well, I remember attending more than one of those and just feeling like I could only scratch the surface on understanding all of it because there's so many different plans and options and different ways that you can invest in hard assets. And it was awesome. I loved that.
Yeah. And I'll just say at the outset of this that those of you who are wondering, what to do with your assets, especially if your assets are in a traditional retirement account and you're not super happy with your options, you should check out self-direction. It is really the only way to go because you can invest in hard assets. And most people are not told that you can do that. That's literally what Jon's business is. So I encourage you guys to check that out, and they are the best. So you should definitely call them. And in the show notes, we'll have contact information for Jon, his company, and all that. So let's dive into the chaotic mess that we find ourselves in, especially with the financial and banking system. We just talked about that a show or two ago, Jon, but give us your 10,000 foot view. Like I explained it in the simplistic way that I know how to explain things, but what is happening here and how big, deep, wide is this? And should everybody be concerned? Let's start there.
I started talking about this a little over 2 years ago. Actually, I believe it was January 21st, 2021, when I started talking about it and predicted high on the inflation rate within a point. And so it's interesting because I was around when Jimmy Carter was president. I was around the last time there was an administration that had this much incompetence and or deliberate attempt to nationalize the country and socialize the country. And I say and or because back then I didn't know what it was, and I was 18, and I just knew that what was happening was all bad. Now when I look at it and I look at the people in charge, which are Joe Biden and Janet Yellen is the Treasury Secretary, and her viewpoints and how she looks at things and her Keynesian philosophy on economics. And I'm using Keynesian in the kindest sense of the word, because I don't want to upset too many people that have different political viewpoints than me, and the Fed. So you have this situation where it started with the immense spending immediately with the new administration. The $2 trillion spending package that came down right after the new Congress was installed was the beginning of the end. It was very, very clear to see that the people in charge have never looked at history and couldn't care about the American people. Their goal is not to care about the American people or empathize with what the American people are going through. Their goal is to be able to spend as much as they can and make people dependent on the infrastructure, which is the government, as quickly as possible. Unfortunately, when that happens, when you spend that kind of money, the Fed has to be aware of what's about to happen. And our Fed, Jerome Powell, I don't believe I believe that he was too involved with the administration at the beginning and waited too long. And when Janet Yellen started saying that inflation was transitional or whatever she said, I mean, I knew it's impossible. You just couldn't have been in economics that long and looked at what was going on with the spending. And the Treasury Department and Yellen have been printing money basically 24/7.
Well, John, she said the other day in one of the hearings that she didn't even think that had anything to do with the inflation. She literally out of her mouth said that.
Unbelievable.
It's everything to do with it. That's how you create inflation. If you have a recessionary economy and you're trying to get people to spend money, you keep rates at zero, you print money and you spend money so that you can jumpstart the economy. If you've got an economy that's already been jump-started by the previous administration and then start spending unreasonably, so far they've spent $2 trillion package, then they had the $1.4 trillion infrastructure package, and then there's some other spending that just happened. I don't even remember how much it was. I just kind of shake my head and forget. But you've got the spending, the out-of-control spending. I mean, our interest rate, at the current interest rates, our monthly, let me see if I can remember this. Our monthly interest payments are over $850 billion a month is what the government is spending to pay the interest on the new rates.
It's literally unbelievable. And it's remarkable to me that there are people who are supposedly educated folks who...
The university is filled with educated folks that couldn't even turn a doorknob.
Yeah. I mean, it's clear that the education that they got was worth about as much as a few sheets of toilet paper.
Well, I think what's happened...
Used toilet paper.
I think what's happened in our economy is it's not that they're not smart people. It's that the division and everything becoming so politically motivated, and that you must destroy whatever the other party did at all costs to the American people. And I mean that seriously in both parties, by the way. I'm not talking about just who's in power today. It's just all about destruction and ripping apart whatever's been done, no matter how good it worked.
Yeah.
Yep.
Right? So every 48 years, you're starting over again. Actually, every 2 years, because every Congress makes one mistake after another. So anyway, you've got this monetary policy, you've got the printing of money, you've got these huge bills. I think somebody predicted that we're going to be at $51 trillion in our debt within 4 years or 5 years. Don't quote me on that. I heard it. It was so massive. I just kind of gasped. But so you've got these two situations, and then you've got Jerome Powell, who gave money away too freely. It was too loose for too long. The minute this inflation started, he should have been on raising, right? We had almost zero interest rates for 15 years. Seriously, 15 years since the last time, this happened in 2008. And
it's a long time.
It's a long time to be at almost zero.
It's almost a generation that doesn't even know that those
Clueless.
Are not normal.
Yeah.
Right. Now we've had, I believe it's 11 months with rates going up every month or every other month for 11 months. So we've gone from zero to, God, I'm going to ruin this too because I've stopped listening, but I think our interest rates are now at 5.75 or maybe 5.25 because they just raised 0.25 the other day. So Jerome Powell, even though behind, is trying to counteract. And if the spending stopped, he could counteract and he could stop this inflation. The problem is the spending isn't stopping. There is no gut or motivation from Congress and from the president to stop the spending. And the advice they're getting from Janet Yellen is, I don't know how many people are old enough to remember the movie Animal House, but this is the best analogy I can give. And I've given it to all of my employees. In that movie, Kevin Bacon plays one of the narcissistic Nazi-like fraternity bad guys. It's when he was like a child. He looks like he's 12 years old. And when the Animal House is driving their float down the parade as they've destroyed this whole parade, he's going, stop, everything's okay. Everything's going to be fine as he's getting run over and trampled by everyone. And that's what Janet Yellen reminds me of. And it just, although I'm laughing about it, it's seriously difficult. You've got the real estate industry where you can't get funding. You can't get financing. If you do, you can't build fast enough or get income fast enough to keep up with the costs of the loans. We were just talking before we started about what is it now? They're paying 8-9% on that.
Yeah, on construction loans.
Mortgages, if you're lucky, you can get a 6. If you have superior credit and no blemishes, you might be able to get a 10-year mortgage at 6 to 6.25. And most people,
that's not an investment loan either. That's just a regular
loan. Primary loan. That's a primary house, and most people are up in 7 to 8 because they're doing 30-year and they're bumping the rates up, they're bumping the points up, and it's difficult when your income is shrinking due to the fact that inflationary pressures on food and gas and fuel for your home is up 30-40%, right? When they do these inflation figures of 7%, we all know that they pull out food and gas. We all know that those figures are figures that make them look good. Those aren't real. Anybody who's bought a dozen eggs in the last 6 months knows they aren't real.
Yeah. No kidding.
So we have this economic situation where a recession was coming. And I think that most reasonable people knew you couldn't stay at this inflation rate and not have incomes keep up, and incomes can't keep up. I'm at a point in my business where my incomes for my employees can't keep up with the massive amount of increase in us doing businesses. And so what's happening is eventually you're going to stagnate. Eventually something's got to happen. Well, it's very interesting the way it happened, because if anybody remembers back in 2008 when they passed Dodd-Frank and all these laws against the too big to fail banks, great, they secured the too big to fail banks, but most Americans, I believe, bank through the regional banking system.
Yep.
And they get and contractors and developers, they all get their loans through the regional banking system. They don't get it from the Chases and the Wells Fargo and the Bank of America.
You can't get it from those guys. They don't
get it from those guys. You can if you're building a multi-billion-dollar skyscraper.
Yeah.
But for most investors and most investment properties, you can't get those loans from those guys. You have to go to regionals. And without that regional system, what you do is you destroy middle America's ability to invest in the future of hard assets.
100%.
And I'll talk about the market a little bit, stock market and stuff, because I know some people out there going, yeah, you're talking about all this bad stuff, but the market really hasn't gone anywhere. Well, okay, let's see. But so here you have this liquidity problem. And there is no businessman that I know or talk to, and I talk to a lot of them. We have about 4,000 clients, and I would say 3/4 are business people. And so I like to talk to a lot of people, and liquidity is a big issue all throughout.
Yep.
All throughout the system. And I said to myself after talking to these people, and by the way, me too. As a business person, I looked at that same problem, had to make sure I was very secure in our finances for our clientele and that we had liquidity. So the greed and scarcity issue that happened was rates went up so fast that the average bank would say, let's invest in these CDs because, these CDs and these government bonds and these treasuries, because the rates are so high, so that we can pay good rates out on our money market and so that we can keep that money perpetually moving. Where in the past, by the way, the regional banks used to perpetually move their money by loaning it out 5 times. Can't do that anymore. And so now they were doing it through treasuries and bonds, which would have been probably okay if the executive and legislative side took 1 minute to look in the mirror and say, geez, we got to stop spending. But they didn't. They increased and increased and increased. And that's a problem because once people start needing money because their inflation rate's so high that they have to get money out of the bank. Once investors need money out of the bank that they've held there at a 3% or 3.5% money market, when they need that because of a lack of liquidity in their businesses due to inflation, where is it going to come from?
Yeah.
So a lot of these banks used long-term CDs and treasuries and government bonds. And when things started to go awry and people needed their money out of the bank, they had to sell. If they were buying CDs at 4 or 5% long-term and they needed that money back, they had to sell those CDs at tremendous losses, or the treasuries or the government bonds at tremendous losses. When I say tremendous losses, we're talking at 5 to 10% loss, all the way up to about 20%. So you imagine that in the billions.
Yeah.
And quite frankly, legitimate business people that weren't looking at the politics and that were looking at their portfolio, when they started to see the layoffs in the tech industry, because you used to hear on the news, not a problem, there's not a recession, a problem, it's only the tech industry. As soon as that came out of people's mouths, those banks should have gone, all right, wait a minute. If tech companies are laying off 5%, 10%, 15%, I know a couple of them just laid off 19% of their workforce this last week. If that's happening, those companies are going to need liquidity, right?
Yeah.
But it's the same thing that always happens. I saw it in 2008. 2008 was different than this, completely different. Anybody that says that it was different is right. It was bad lawmaking from a decade or two earlier, and it was the laws that allowed them to separate assets from income. That's not this problem. This problem is a liquidity problem. So the first thing that I about fell off my chair on is what was the bank in California that failed? CBB?
Yeah.
SVB.
SVB. When they failed, there was a lot of information out. They didn't have a board that knew anything about finance. Their entire board, they had one person on their entire board that actually came from the banking and finance industry.
What?
Well, they had no risk manager.
They had no risk manager. They had no one watching risk. So they had no risk manager. They had no risk management program. And all of the other board members were politically placed. They were all associated and related to major donors in the Democratic Party. And as a matter of fact, themselves were some of the biggest donors in the Democratic Party.
Yep. All true statements.
Right? So sometime, some way, businesses have to do business not as what's woke and not what's DEI, but what is financially responsible. I don't know when we're going to get to that, but man, we're not done.
Yeah.
So, and then of course your second bank that had Dodd on the board from Dodd-Frank that did the original laws back in 2008.
I mean, so, if you were going to write a script,
oh my gosh, you could write a movie. This
is a comedy that ain't funny. It is, but I mean, come on. I mean, Dodd-Frank choked the life out of mortgage brokers, out of small banks, and regulated the snot out of them. So so many of them went out of business or got gobbled up by large banks. And here you have the same one of the two same morons who, I mean, they didn't write it, but it was their legislation sitting on the board of a failed bank.
Actually, Frank, that was at the bank.
Unbelievable. And it got almost nobody even knows that. That's the tragic thing here is that, there's so much. I don't know how many times I've said this on the show, Heather, but the government literally F's something up so bad.
Yeah.
And then they bitch about it as if they didn't create the mess. Yeah. And then they come in and fix it by breaking it worse than it was when it was broken the first time. And it just continuously gets worse.
Come on. It was the last president. Whoever the last president was, it was him that did it.
Well, to your point, we spent plenty enough money under Trump. We didn't need to double, triple, and quadruple down on what Trump spent, right?
Yeah, he wasn't innocent either.
Yeah. I mean, and Trump, I said this on here too before, but he's the one who eliminated contract law and said it was okay to not pay any of your bills. That wasn't Biden. That was Trump. So there's a whole lot of blame to go around here.
Exactly.
Absolutely. So, and here we are with Janet Yellen comes out. This is the same genius that came out and said that inflation was transitory 5 inflation points ago. And in 2 years, she comes out and she defends raising FDIC rates or having the Fed raise FDIC rates to pay off all of these billions instead of the 250 max. Problem with it is she then, after that statement, immediately says, oh, this is done. It's only these 2 banks. There's no other problems. This is the person in charge of monetary policy for the entire country. Yeah. And as a matter of fact, she's so nosy, she likes to be in the monetary party of the policies of the entire world. She's been in Ukraine. She's been in Germany. She's been all over with her fingers in everybody else's monetary policies. And here's what's happening. Now you've got Credit Suisse, who's having a liquidity problem. And you've got, I'm trying to remember the other one, First Security, that the bigger banks are coming in and saying, we will keep them alive by putting $30 billion, propping them up with $30 billion. You've got UBS that's trying to buy, I think, Signature. I think they're involved with the deal with Signature. I don't think anybody wants to save SVB. And as of today, Deutsche Bank is now having liquidity problems. So This is not a one-off deal.
Wow.
This is going to continue as long as these rates go up. And I don't know what the Fed does about this.
Well, there's not a whole lot they can do, John. I mean, like you said, they waited too long.
Now they're the only ones that can do it. They need a Treasury Department and a president that will just shut down the spending and the printing.
Yep.
And they're not getting it. The Fed's getting no help. So here's a guy, I actually feel for Jerome Powell. Not that I think he's a great Fed chair. He's certainly not a Greenspan or some of the other people that have gone through this stuff and dealt with it. But I really feel for him because he's got no allies. He's got nobody helping the only thing people are doing is people like Elizabeth Warren are getting on TV and blaming him that he solely alone is going to cause the demise and the recession in America. So they're already going, blame him. Don't look at the people that made the problem. Blame him. Yeah, it's already started.
At the same time, they're trying to pass what is it, a $4 or a $5 trillion budget. It's remarkable to me that they can't figure this out at all.
6.8 trillion. Not to correct you.
Sorry. Yeah. A little light. So
don't underestimate.
So John, I mean, I think
6 trillion is unnecessary spending, I'm sure.
It's a rounding error at this point, isn't it? I mean,
right?
What's $1 trillion between friends?
No kidding.
If you were to spend $1 trillion, if you were to spend, how long would it take? And how much would you have to spend $1 trillion in 114 years? Actually, let's make it better. 64 years. What would you have to spend an hour every hour of the day to spend $1 trillion?
Oh, I don't even know.
Yeah, I don't know. It'd be
hundreds
high.
of billions.
You'd have to spend $2,000 per hour, every hour, 24 hours a day, 7 days a week, 365 days a year for 64 years to spend $1 trillion. Yeah,
that's
Think about that.
Wow.
That's insane. For one, and our deficit's gonna be, what'd you say, 51 trillion?
I think. Well, the prediction was, I don't know if it's right now. I think I'm not even sure. We're at 32 or 38.
Yep, we're well over 30. And,
yeah,
and I remember everybody was banging the drum when we broke 20, and that wasn't that long ago.
Yeah,
I remember when we were speaking in 2008. And I used to put up the inflation clock, and I was like screaming about the deficit, and we were at like 12. We had gone from 5 to 12.
I remember that actually. That's the number that sticks with me is 12. So what does this mean for investors?
Well, I'm going to give you my best estimate. You have a very unstable stock market. You have a bond market where prices are low and interest rates are high. Bond market works like a seesaw. So as interest rates go up, bond prices come down. So you've got interesting yield curves happening. By the way, there's no flow to quality, because now what's happening is people that would have flowed to quality out of the stock market and into the bond market after watching what's happening with the banks are probably scared to go into the bond market. Because they're afraid inflation is going to continue to go up and their bonds will be worth less.
Yeah.
Right? Which is what's been happening the last 11 months. So there is no flow to quality. We had a flow to quality back in 2008. We don't have that to fall back on. And I think that's probably what's keeping the stock market relatively stable, but we're starting to see awfully big swings. Yeah, and I would love to see money start leaving the stock market in droves, because guess what? It comes to us.
So the stock market becomes a trader's paradise, but for the average investor,
they go nowhere.
It's scary. It's really scary.
Yeah, you can't watch it. You either have to stay in and not watch it or get out and deal with whatever happens. The problem is, if you get out, where do you go with inflation rate this high? My opinion is you go into hard assets. You look at real estate. Not to say that real estate isn't going to start dropping at some point in time. It already has in many markets.
Yep.
But rents are stable. Rents, I believe, are going to have to come down a little bit at some point in time, because people can't afford rents on current pay structure. So they're staying stable. And if prices are coming down, you get to buy a little more real estate. I sound like a broken record, because this was me 2008 through 2010. I feel like I'm stuck in a time warp. That there's no safe place, but but what I personally am doing is, my place that I want to be is where I can get income instead of worrying about growth right now. Because the growth that you get probably isn't going to match inflation right now. So you have to keep income stable during this period of time. And by the way, this period of time isn't going to end anytime soon. My prediction 2 years ago is this would be a 4 to 6 year process to get through the recession, to get through the stagflation, and to find new leadership to try and turn things around. Won't last forever. It never does, but it will last probably for another 3 to 4 years. I don't think there's any quick way out. So my best opinions, keep liquid. Make sure you have enough liquid. Money markets aren't so bad right now, so keep stuff in money market. You can get 3 to 4%. Even though that's not going to beat inflation, it helps you sleep at night. It helps you sleep at night, stay liquid, spend wisely. All the American style of living, be cautious. I know that we're cutting back on things like trips and remodeling houses and stuff, just spend wisely and look at hard assets. I don't believe that the stock market's going anywhere on the upside. And if we do go into a deep V recession, which everybody talks about this soft landing. It's like, I love how they tell you, every time this stuff happens, you hear the same thing from all the talking heads. Oh, it's going to be a U. It'll be a soft landing, except for the millions of people that are in bankruptcy and can't find a place to live and can't afford food.
John, they're only talking about the people in the Beltway. They're only talking about
with the Beltway. There won't even be a recession.
Yeah, that's all they're talking about. They're like, "What are you talking about? It's a soft landing. Nothing happened." And those people never leave DC. I think they just hang out there all the time. They're completely disconnected from the rest of reality.
Well, for the rest of America, it ain't going to be such a soft landing. It's already, people are starting to feel that deep V. Seriously. And so you've got this deep V recession that's probably going to happen. And it's going to stay down there until policies change. There's no way out until there's a change in policy. Do I know what that right policy is? No, it's going to depend when we get down to the bottom. But in the meantime, while we're there, I think the stock market's got some suffering to do. Part of the reason I think it's so stable right now is the amount of money in there. It's so much greater than ever in history. The trillions that are in the stock market, it's just larger. It's basically like an elephant. And so therefore it moves slower. And therefore those drops or those bear markets, it's harder to come by them, but they move slowly. It's the frog in the water thing.
Yeah.
So the frog in the cold water doesn't know the water is getting hot until it boils. I believe that's what we're going to see in the stock market, where it doesn't happen overnight like it used to. It does this thing where it goes down 500 to 1,000 points, comes back 300 or 400 or 500, goes down. It'll be like this, just the water warming up, and people won't realize that it's happening unless they pay close attention.
What's going to happen with commodities? Because I keep trying to figure out when it is that we're going to be able to build affordable housing again. Because right now, as you know, John, everybody's complaining about there not being any affordable housing. You literally can't build it. It's impossible to build it. So until the bits and pieces it takes to build structures, to build apartment complexes and homes comes down, we aren't going to be able to do that.
And be honest with you, it may never come down, because when you're talking commodities, it doesn't matter what kind of commodity it is. If you're talking corn, the cost of fertilizer has gone up tenfold. So farmers are being squeezed, where even an ear of corn that goes into ethanol has to be raised so high for them to even break even. And they're not breaking even. And so you look at corn, or you look at any of the cash crops, the soybean, the thing that are all of our food, right? Those crops are just being blistered by the fertilizer cost. Blistered. And cost of water, right? And the cost of diesel for the tractors. They haven't figured out a way to make an electric diesel that can actually do farming. So I think they'll be doing that right after they get the electric airplane up.
So this is fascinating to me, John. Let's think this through just for a second. I've been trying to figure out house prices. There are some areas of the country that are overbuilt. People have moved out. People are not moving in. That's normal supply demand stuff.
Sure.
But in a lot of the country, there's still not enough supply for the demand.
That's right.
And the prices of the materials have not gone down. The price of land has not gone down because there's not as much of it. It's continuing to go up.
Right.
Which is causing all of the expenses for the people who provide the housing to go up, which means rents can't contract or they lose money.
Not right
which
now.
is pricing people out of the market, all as the interest rates rise. Some piece of this has got to give, and I'm trying to figure out what piece it is because...
Well, the cracks are showing. It's the liquidity. As soon as people run out of liquidity to run their businesses, the recession hits.
And what that means...
just waiting for that hammer.
And what that means, John, then is that everything's going to slow and grind to a halt. What happens with pricing at that point? Because there's not... only in areas where they're overbuilding.
It depends on inflation. It depends on what happens with inflation. So unfortunately, the people that control inflation happen to be the Fed and the Treasury and the executive branch. And of course, the legislative branch and the policies and laws that they pass. So until you have, instead of smart people in government, you have people that have written their name on the front of a paycheck or have been on the farm or have suffered, are old enough to have suffered through a couple of these and understand nothing's going to change. So the immediate action for government is, if everybody's suffering and in trouble, what does the government do? They support them, right? And it's happening at an alarming rate because we know what that means.
Yeah.
If the government is supporting everyone on everything, all you have left is socialism and communism. If nobody is on their own taking responsibility for what's going on, and I know that sounds a little harsh, and it is a little harsh, but I just hear the massive complaints by business people every day. The lack of employees, the lack of being able to get supply, increased labor, the increased cost of everything.
Mm-hmm.
I mean, I'm watching we have an 11,000 square foot building, and I watch our utility bills, our gas and our electrical go up every month. I mean, that's real. That's a real thing for people. It's a real thing for businesses that have bricks and mortar.
Yep.
Every month.
Yeah, and not every business is able to be transitory like inflation.
Right.
Some people have to actually have brick and mortar. And
that's right.
Serve the small businesses or serving communities, they have to be in the community. So, man, this has been really fascinating, John.
Enlightening. And I don't know if it's a good enlightening.
I don't know. Good enlightening, too. I mean, I have opinions on it. And I just don't know. I don't say that often because you guys know I was very, very opinionated. I was right on the money back in 2008. I mean, I called the bottom of the stock market within 50 points. When it was, when the market was sitting at 10,000, I called the bottom at 64 and it was 64.50 something. It was easy to call it. This one's a lot harder. And the reason it's a lot harder is the government's interfering too much.
Yeah, there's too many levers being pulled
in
different directions. And it's like they're doing it on the fly. Like nobody.
Yeah. I think it's on purpose. But,
like there was all this speculation surrounding whether or not they were going to raise rates. Well, they said they were raising rates. Nobody said they weren't going to raise rates. But yet everybody out there, all over the talking heads are saying, well, they can't raise rates.
They can't. A while because of liquidity problems. No, they don't.
Well, yeah.
When you look at the problem is banks can't get a hold of money for people after Janet Yellen says it's okay, we'll pay them back, and we got to get inflation under control because it's literally killing people, literally, by having inflation so high. The Fed is not going to change their policy. They're going to continue to try to get inflation under control. It's not going to stop. Especially with a treasury that says, don't worry about it. If your bank goes under, we'll take care of everything.
Yeah, exactly.
Yeah. So
just made it clear.
Yeah.
So the simplistic answer is you need to invest in things that produce cash flow because cash is being removed from you through inflation and through the means to end inflation. Both of those things are removing cash from you right now. And you have to have things that produce cash. Businesses, real estate, things that actually produce cash. Well, I couldn't agree more with that.
Well, that's usually throughout my life. That's been kind of my answer. When everything falls apart, hard assets and cash flow. Find a way to have cash flow.
Yep.
True.
Well, man, we really appreciate your wisdom and having you on. I think, sometimes you just have to have a hard conversation, right? People need to listen to what's going on. And it's not all sunshine and lollipops, unfortunately.
No, and it's not going to be for a few years.
Yeah.
Yeah.
You guys are both much younger than me, but at this point in time, where I would have liked to start thinking about maybe I can slow down in life, it's like my work is harder than ever. I'm working more hours and dealing with more stuff than ever.
Yep. I think a lot of people are in that, and we're probably going to be in that for, John's saying 4 years, 3 to 4 years. I think that's pretty accurate. I see no end this year. I don't think real estate's going to correct.
The worst is yet to come.
Yeah.
Guys, the worst is yet to, we are just getting started. We're at the top. As bad as this is, we're not at the bottom.
Yeah.
No kidding.
Well, we really appreciate it, John. And
Thanks.
If you guys want to get a hold of John and his company, we will put the contact information in the show notes. You should reach out. They are a wealth of information about how you can, invest in hard assets, get your money working for you instead of watching it completely fall apart in front of your face.
I would add too that one thing I love about your company, John, is that you're a small enough business that you can call and talk to a person. I love that about
always
you.
Been our trademark.
And their website is mwira.com for those that are listening and don't have the show notes in front of them. So,
yes, we appreciate it. And as always, people, maybe now more than ever, get out there and make something happen.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.